I think that, there were no surprises in the speech. It'd certainly be nice to hear something different. But, to the point that the clear and present danger in the market right now is trade and trade policy. And the president came out very strong on trade. And I think to that point, he's got a lot of support, right? So when you think about trade policy and that being the biggest headwind in the market, addressing that head on, there's a lot of other things that seemed as dark as the inauguration speech a couple of years ago. And that doesn't help the cause. But I think that when you think about what the market cares about the most, it cares about trade first and foremost, and I think he was very strong on trade. Probably helps, having support globally to get something done in negotiations with China, on or around November.
Yeah, and Krishna, looking at this speech from President Trump, a lot of comments on oil and energy independence here in the U.S., going after OPEC again. It certainly seems to be adding even more support to what we're seeing in Brent today, which is trading about 81.50. It's at, the highest in over 4 years. How is that reflecting back onto the markets more broadly, too?
Well, so I think oil is important, but he has been talking in these terms for quite some time, so there was really nothing new. And given that there's really nothing significant that he can do other than maybe releasing the Strategic Petroleum Reserve, which would be a mistake, I don't see how it changes things. I think the key thing is really trade. But the other gentleman mentioned that he has a great deal of support with respect to his current trade policies. I have a tremendous difficulty with that. That is, tariffs and tariffs in current form don't really accomplish what we are looking to accomplish, which is to reduce our trade deficit. To reduce trade deficit, there's a simple path forward, which is to reduce our fiscal deficit, and our fiscal deficit is widening rather than shrinking. We need to do that before we can expect the trade deficit to diminish. Tariffs won't get us there.
Art, what do you make of the market's reaction to these trade tensions, which seems to be not that much of a reaction? Are they linked at all? And if they suddenly do begin to become linked, or if the markets cool off somewhat, does that affect then the way investors should look at trade and tariff policy and its future implications?
John, that's such a great question. That's the question we get the most. Why is it this market seems to be able to ignore what's going on and shrug off concerns and trade tensions, especially now that we're getting escalation? And I think there's three things that go into it. I think the first and foremost, the simple math here right now, if we just look at everything we've done to China and look at that as a burden on U.S. GDP, it's about $35 billion, juxtaposed against a $17 trillion economy. So I think that's probably the wrong way to look at it, but I think that that's one thing. I think the second thing is everyone still believes that there is a possibility that there's an exit ramp on this trade war highway, and that this is part of the art of the deal and we're negotiating. I think the third thing necessarily, and probably the most important, is this is all happening with a strong economy. If we didn't have a 3% GDP growth rate, and we were attempting to have very aggressive trade policy, then I think the market would have a much larger reaction. But this, this extends into next year and, becomes a mutually destructive trade war. The market's going to wake up and take notice. Right now, it seems to be falling into that category where it's manageable.